This webinar is going to cover IFRIC 22 on foreign currency transactions and advance consideration. We will also deal with the amendments to IAS 40, specifically around the transfers of investment property. My name is Raymond, and I'm going to be facilitating this webinar. We'll start off by having a look at IFRIC 22 on foreign currency transactions and advance consideration. This particular interpretation was issued back in December of 2016, and it relates to the application of the standard that we've always had on foreign currency transactions, which is IAS 21. What we'll do as a starting point is we'll have a recap of some of the issues that are dealt with in IAS 21, and these are as follows. IAS 21 starts off by giving us the different definitions of functional currencies. It talks about presentation currencies and the process that we need to follow in determining what our functional currency is. It then goes on to deal with the recognition and measurement issues, the recording of transactions, how we differentiate between what is a monetary item, what is a non-monetary item, and the different rates, foreign currency translation rates that we should be using for these various items. It also talks about at what point, the rate at what point we use when we're converting a foreign currency balance into our presentation currency or our functional currency. Now all of that is dealt with in the standard itself, and the standard then goes on to deal with the presentation and disclosure issues. And these are issues such as when you prepare your financial statements, we need to go and explain what currency we're reporting in, we're presenting the financial statements in, what currency is your functional currency, what exposure to risk you may have from time to time, and to the extent that you've got any foreign subsidiary companies, for instance, what you do with any recycling of translation differences when those exist. IAS 21 deals with two key concepts right from the onset. It defines functional currency and it defines the presentation currency. And functional currency is the currency of the primary economic environment in which the organization operates. It's the currency that an organization will use in measuring and recording the various transactions that it undertakes when it puts them into its financial statements. Now with functional currency, there's literally no choice that an organization can make to use a currency that is different from the currency in which all these transactions are recorded. Now that differs from the presentation currency, because with the presentation currency, an organization has a choice in terms of what currency it chooses to present its financial statements in. That can be different from its functional currency, and as long as an organization is presenting its financial statements in a real currency, that currency that it chooses can be pretty much any currency it chooses. An organization is required to select its own functional currency based on what are called primary factors, and we also have secondary factors that must be taken into consideration in deciding which way to go. Primary factors are such factors as what influences the sales prices that an organization applies in its business, the currency that influences the labor costs, and any of the other significant costs that an organization needs to incur in order to keep its business running, or the currency of the country in which the organization operates and whose competitive forces and regulations determine what the sales prices are that this organization is going to charge. Once you've been through these three factors, you might then come to a conclusion that this particular currency should be your functional currency. If for whatever reason you're unable to come to some sort of conclusion as to what your functional currency should be, then the standard is, well, have a look at the secondary factors. And secondary factors are such things as the currency in which an organization funds its activities. So if you've got significant borrowings or you're raising money from your shareholders, what currency is that money raised in? Another factor that can also be considered is the currency in which receipts from operating activities are kept. Now, different jurisdictions across the world have got different rules when it comes to this. Some jurisdictions will insist that if you've got export proceeds that are coming in, that those export proceeds are converted into the local currency as and when they as and when they're remitted into your country of residence. Some jurisdictions will not have requirements of this nature, and they will allow you to maintain foreign currency accounts. Now again, all of these factors must be taken into consideration in deciding with what your functional currency should be. Another factor that you can also take into consideration is, do you have a parent company, and are you acting as an extension of that parent company? To the extent that you are, and all your funding comes from the parent company, the receipts and payments that are made are done on your behalf or are done in conjunction with the parent company. Whatever the functional currency of that parent company might be, you need to consider whether or not you shouldn't be looking at that as your own functional currency as well. Whatever the currency is that you end up with, standard says, well, once you've chosen or you've come to a conclusion as to what your functional currency is, you should not make any changes to that functional currency unless the underlying transactions that have led to your decision making in the first place have changed. And where you do have a change, or any changes that you make to your functional currency must be undertaken on a prospective basis, and you'll also be required to go and explain in your financial statements, disclose the reasons in your financial statements why you've changed your functional currency. There are a few general principles that we need to apply when it comes to the conversion of foreign currency transactions and balances. All foreign currency transactions that are undertaken must be recorded at the spot rates that are ruling at the time. If I'm dealing with a monetary item, then the standard says to me that I must always use the closing rate. So if I've got things like my foreign currency denominated receivables, for instance, those must always be converted at the closing rate. However, if I'm dealing with non-monetary amounts, items in my financial statements, then those must always be converted at the historic rates. We'll go into a little more detail just now about the sort of items that make up monetary and non-monetary items in our financial statements. The standard also deals with a third type of transaction, and that's where we've got items that are carried at fair value in the financial statements. And these are always carried at the rate that is ruling, or converted at the rate that is ruling at the time that the valuation is undertaken. I'd like you to take a few minutes, of a minute or so, just to have a look at these items that I've got in front of you now, and consider how you would classify these. What rates of exchange would you use? So would it be the current rate of exchange? Would it be the historic rate of exchange? What rate of exchange would you use for these items that you've got in front of you now? What we need to do when you're looking at a list of items, transactions that you've undertaken, such as these, is to determine whether or not they are monetary, non-monetary, are they carried at fair value, and so forth. And in making that distinction, that is what is going to inform the accounting, the appropriate rate of foreign exchange that we should be using against that particular item. Where we conclude that something is a monetary item, then the standard says that that item must be converted at the rate that is ruling, the closing rate, the rate that is ruling at the time that the balance sheet is put together, the financial statements are drawn up. So monetary items are units of currency that are held by an organization, or there could be assets and liabilities that will be received or paid in a fixed or determinable unit of currency. Now, the sort of things that you typically come across that would fall into this category of monetary assets are trade payables, trade receivables. We spoke about these earlier, where you've got debt securities. Deferred tax, funnily enough, also fits in under this particular categorization. And any provisions that you may have on your books, that you may carry on your books, that you know will be settled in cash at some point in the future, those also meet the definition of a monetary item. Non-monetary items, on the other hand, include prepayments. So you've paid in advance, you've been paid yourself in advance. That item would meet the definition of a non-monetary item. Goodwill, intangible assets, those all meet the definition of non-monetary items. Inventories, property, plant and equipment, those sort of things would meet the definition of non-monetary assets, and therefore in accounting for these items would then have to apply the historic rates that relate to these items. While we're here, I would like to point out though that when it comes to things like goodwill, and I guess everything that we've got on this list, if we were converting the balance sheet of a foreign subsidiary company, then we wouldn't make this distinction between what is a monetary and a non-monetary item, as all items on a foreign subsidiary company's balance sheet are converted at their closing rate. So all assets, all liabilities are converted at the closing rate. However, when it comes to your equity items, those items are not converted at the closing rate and are converted at the rates that were ruling at the time that the transaction was undertaken. Now, in doing that, what's that going to result is that it always then gives rise to the foreign currency translation reserve that you see that arises when you do a conversion of a foreign sub, because you're converting everything at different rates. Income statement at the average rates that were ruling at the time of the transaction. You're converting your balance sheet, assets and liabilities at the closing rates. You're converting equity transactions at historic rates. So you're always going to have that imbalance that the FCTR, the foreign currency translation reserve, then deals with. Now, having gone through the definition of monetary assets and non-monetary assets, I'd like us to take a look at that list of assets and liabilities that I gave you before, and equity instruments, I guess, that I gave you before, and let's see where exactly we would end up and whether or not we would have gotten the right answer based on what we know. So trade payables, we should have converted those at the closing rate. When I look at my inventories, I convert those at historic rates because those are effectively a non-monetary item. Trade payables being a monetary asset, monetary liability. Share capital that has been issued in a foreign currency, that is converted at the historic rates. Equity, generally speaking, is always converted at the rate that was ruling at the time that the amount became due and payable to the organization. Deferred tax, we spoke about just now, and we said that is dealt with as if it's a monetary item, so you use the closing rate on that. Inventories, if I bought inventory 3 months ago, whatever the rate that was ruling at the time is what I need to apply. So my inventory might have been bought over a period of time. Whatever the rate was at the time, that's what I should apply. So some of it may be at the rate that applied 3 months ago, some of it may be from 2 months ago, some of it may be from last week, but I must always apply the historic rate that is applicable to the items of inventory that I'm holding on to. For items that are carried at fair value, here we've got a slightly different way of approaching it. That we must always use the rate that was ruling at the time that the valuation was done. So we undertook a valuation on the 15th of December and we have a 31 December year end. That investment property that we've determined the fair value for, that foreign currency value of that investment property must be converted for the purposes of financial reporting at 31 December, but must be converted using the rate of exchange that was ruling on the 15th of December. If I've got any investment property that is carried at cost, there I go with the historic rate. If I've got any cash that is held in a foreign currency account, for instance, there I go with my closing rate at 31 December if I have a 31 December year end. Any available for sale equity instruments, those are measured at fair value. So again, I must determine the date on which the fair value was ascertained, what is the rate ruling on that particular date, and use that particular rate for the purposes of converting for reporting into my financial statements. Now that's my application of what is sitting in IAS 21 on foreign currency transactions. The issue that arises, that faced the IFRIC and which they had to put out this interpretation for, relates to non-monetary items, prepayments, and those sort of transactions. IAS 21 requires that transactions be recorded at their spot rate at the date of the transaction. And again, IAS 21 goes ahead and defines what the date of the transaction is. And this is the date on which the transaction first qualifies for recognition in accordance with IAS 21. So when an asset or a liability arises and the organization is required to account for it, whatever the rate ruling on that particular date, that's the date of my transaction. Now the problem comes in is that what happens where I've got a transaction that has got multiple transaction dates? Which rate of exchange do I apply? That has not always been clear from what we have in IAS 21. So this is why there was a need to go back and issue an interpretation that relates to this particular matter. So I'll give you a few examples just now to paint a picture of what it is that we're talking about. If I find myself in a situation where on the 1st of June, as an organization, I make a payment towards the acquisition of an asset of $1 million. But the asset that I'm paying for is only received a month later on the 1st of July. The issue then becomes, well, at what rate of exchange do I record this transaction in my book? Do I record this transaction at the rate that was ruling on the 1st of June? Do I record the transaction at the rate that was ruling on the 1st of July? So it's making that distinction that has caused some of the chaos that we've seen in the past, some of the uncertainty that we've seen in the past. So in responding to this, what the Interpretations Committee did, so they determined that the date of the transaction should be the earlier of the date of initial recognition of the non-monetary prepayment asset or the non-monetary deferred income liability, and the date that the asset, expense, or income is recognized in the financial statements. Now go with whichever of the two comes earlier. That's the one that we need to determine, and that's the rate. The rate on that particular date is what we're going to consider. So again, taking you back to the example that I gave you just now with Euro Limited. If I pay $1 million on the 1st of June, and if I apply this interpretation that we've got now, then the rate of exchange that I apply, that I must use, must be the rate ruling on the 1st of June, because that's the date at which an asset was created, is that I've paid in advance for the receipt of an asset that will come in only a month later. So therefore I must use the rate of exchange that was ruling on the 1st of June for the recording of the prepayment that I've made, the asset that I've created in my books. So that one might sound pretty straightforward. The issue comes in where you have multiple payments. So where I do have multiple payments, and again I put myself in a similar situation to what I had just now, except that I'm not going to pay the entire $1 million up front. I will pay a portion of it. So assuming that I pay $700,000 on the 1st of June, and on the 1st of July, I pay the balance of $300,000, and at that same date, I also receive the asset. What rate of exchange should I be using in that situation? And the answer is pretty straightforward, based on the interpretation. Looking at what we had in IAS 21, it wasn't so clear, but now with IFRIC 21, IFRIC 22 having been issued, it's now very clear that the rates of exchange that we should be using are the rates of exchange that we're ruling at each transaction point. So effectively, what I would need to do is I would need to determine the rate that was ruling on the 1st of June. I also need to and apply that to the 700,000. Determine the rate that was ruling on the 1st of July. Apply that to the 300,000. Now those two numbers put together will then give me the value of the asset that I will then ultimately recognize. So while it's an item of property, plant and equipment that I eventually end up with, but my conversion of my exchange of the payments that I make towards that asset, I may find myself in a situation where I apply a rate of 10 to the $700,000 that I paid on the 1st of June, and I apply a rate of 11 to the 300,000 that I eventually pay on the 1st of July, and the total of those two numbers will then give me the value of my asset that I will then take to property, plant and equipment come the 1st of July. Now this particular interpretation is effective for periods beginning on or after 1 January 2018. The standard gives, the interpretation gives us particular application criteria that we need to consider. It says to us that we need to apply the standard retrospectively to each prior reporting period. That's one option. So if you do decide to go that particular route, in the event that you've done something different in the past, you would have to go back and you need to make a change, effectively correct what you've done in the past, but all of it will then be dealt with as a change in accounting policy because of the issuance of this particular interpretation. Or alternatively, you could apply it prospectively to all assets, all expenses and income initially recognized on or after the beginning of the reporting period in which the entity first applies the interpretation, or the beginning of a prior reporting period that is presented as comparative information in the financial statements of the reporting period in which the entity first applies the interpretation. You make a call in terms of what it is that you wanted to do there. It's up to you. But as long as the accounting policy, as long as your financial statements then explain that this is the transition process that you have followed in adopting the changes that IFRIC 22 brings about, that should be okay. The end of what we have from IFRIC 22. The next change that we're going to look at arises from IAS 40 on investment property. What we'll do, the standard itself has been around for many years now, and I think this is one of the the few changes that we've had to the standards during the time that we've had it. There's been a few clarifications as we've gone along, and again, this is a clarification specifically related to where there is a transfer, or there's a change in the use of property. At what point are we required to go and make a change to its classification in preparing our financial statements, in presenting our financial statements? Similar to what we had with the IAS 21 that we've just covered now on foreign currency transactions, IAS 40 also takes us through a similar sort of process where it defines what investment property is and it compares it with owner-occupied property. We'll go through that in a little bit of detail just now. It deals with the recognition and measurement issues around investment property. It defines what an investment property is, defines an asset, defines an investment property. It then talks about the initial recognition. It talks about the subsequent recognition of investment property, and there it gives us choices. You can go cost or fair value. It talks about the transfers of property in and out of investment property. It talks about the disposal of investment property, and it also warns us not to double count investment property where you've got them, because you may find in yourself in a situation where the investment property that an organization has got is also made up of other items of property that may meet the definition of property, plant and equipment, for instance. For instance, property that is let on a fully furnished basis. In that scenario, the valuation of the property may be all-encompassing, including the furniture that is included in that property. But from an accounting point of view, we might have separated the furniture and fittings and recorded them separately from the investment property itself, but because the valuation has been undertaken on a fully furnished basis, then we effectively end up double counting those two items of those two items of assets. There are also a few accounting issues around how do we deal with mixed-use property, the separation between owner-occupied property and investment property, and how that should be undertaken. Property interest that is held by a lessee under an operating lease. Remember, IAS 40 permits the lessee of a property to, if they're subletting that property, to also account for that property as investment property. IAS 40 also deals with where you've got investment property, but you're providing ancillary services to support that property. Is that do you still have investment property in that situation? So if you're providing cleaning services, or you're providing support services, you may be providing security services to tenants in a building that you operate, are you still in that investment property mode, or should you be looking at this as owner-occupied property? So we still need to make all those distinctions, but IAS 40 takes us through that entire process. And it also deals with situations where, for whatever reason, we are unable to determine fair value reliably. How do we address that? And the fact that we've got choices, we've got a subsequent, from a subsequent accounting point of view, we can account for investment property either at cost or at fair value, depending on whether or not that fair value is easily determinable. The standard also gives us this ability, this choice, in the event that we've chosen to go with fair value, and for whatever reason we aren't able to determine fair value reliably on an ongoing basis, to fall back on cost. And in falling back on cost, to use the last fair value amount that we determined as deemed cost. That is permissible under the standard. But we'd obviously need to explain that where we have gone and we've gone and used this deemed cost, why we have done that. So from a presentation and disclosure point of view, where we're applying the cost model for whatever reason, what is the fair value of this particular asset? If we've chosen to go cost, well then talk about fair value. If we've gone cost because we're unable to determine fair value reliably, then again explain all of that. On what basis have you determined fair value in the past? Does the fair value lie within a wide ballpark? If it does, then again that must make it into your financial statements as a explanation. Let's have a look at the definitions that we spoke about just now in a little bit more detail. IAS 40 defines investment property as property, could be land, could be a building, could be part of a building, it could be both, land and buildings, that is held by the owner or by a lessee, we spoke about that just now, by a lessee under a finance lease, with the intention of earning rentals, or for capital appreciation, or for both. It's up to you. You make a call in terms of which one you're holding it for, rather than, and this is as opposed to buying into a building with the intention of using it yourself, so for use in the production or supply of goods or services, or for admin purposes. If I was using a building for production or administrative purposes, then that's an owner-occupied property, and that must be dealt with as part of property, plant and equipment under IAS 16. If you look at the definition of owner-occupied property, property held by the owner or a lessee under a finance lease with the intention of using it in the production or supply of goods or services in the normal course of business for admin purposes and so forth. If I find myself in that situation, I must go to IAS 16 and account for that as property, plant and equipment. Now that we've been through these two definitions, how then do we recognize investment property if we conclude that the property that we've got meets the definition of investment property, so therefore we must apply IAS 40 to it? How do we then recognize it at initial recognition? And the standard is pretty clear. It says whatever investment property you have must be recognized initially at cost. And in recognizing that investment property initially at cost, we must also include any transaction costs that we incur as part of that process, as part of that transaction. So if I pay stamp duties, if I pay transfer costs, if I pay lawyers' fees in order for that property to be registered in my name, all those costs must be capitalized to the cost of the asset. All of this is an initial measurement. Subsequent measurement, I have a choice. We've spoken about that to some extent now. If I decide to go cost for whatever reason, I can't determine fair value reliably on an ongoing basis. We've thrown money at this, and whatever number we're getting back is not reflective of what the fair value of the asset is, or it's in such a wide ballpark that we can't put our finger on exactly how much the property is worth. Then the standard says, well, if that is the case, go and apply IAS 16. But in applying IAS 16, we also need to take the consequences that go with IAS 16, which is we need to determine, we need to determine the useful life of the asset. We need to depreciate the asset over its useful life. But with investment property, the presumption that we work with is that residual value of this property is going to be zero, is going to be null. So there'll be nothing left at the end of the property's useful life to us. That's where we apply the cost model. The alternative, and which is you'll find, I guess I shouldn't really call it the alternative. The first price should be carrying the property subsequently at fair value, with the cost model being the alternative in the event that you can't determine fair value reliably. But the fair value model is not the same as a revaluation model. The thinking behind the fair value model that we apply to investment property is that we must determine at each reporting date, what is this property worth? So again, applying the principles that we have in IFRS 13 is that if the market was paying for this asset, how much is the market happy to pay? So how much would I be able to walk away with from the sale of my property? That's the fair value of this asset. Any changes in value from one period to the next that arise from the application of the fair value model, those changes must be recognized in profit or loss. If for whatever reason, again we've covered this, we're unable to determine fair value reliably, then we can apply the cost model. But remember, there's that consequence that we spoke about before, that we must then disclose in our financial statements the reasons for the change, the reasons why this fair value cannot be determined reliably any longer, or the fact that the number sits in a ballpark, in a wide ballpark. Whatever that may be, we need to go and explain that, and also explain while we're at it the basis on which we would be comfortable that we've got the right number, where we offered the right number if we ever come to selling our property. That will then give the user of the financial statement some comfort around your ability to realize the value that may be sitting in that property. Whatever model you choose, fair value or cost, you need to apply that consistently across all investment properties. You can't have a situation where some properties are carried at cost, some properties are carried at fair value. There's got to be consistency all the way through. The only time that you'd have an exception is where you say, for whatever reason on a particular property you can't determine fair value reliably, even though you've thrown money at it, you're still not in a position where you can determine the fair value of that particular property. In that situation, then yes, you can fall back on cost on that exception, but everything else there must be that consistency of application of policy. The other thing that you can't do, while we on the topic of consistency of application of policy, is you can't pick and choose and chop and change from one period to the next the basis of valuation. If we decide fair value is it, then it's got to be fair value all the way through. If we find ourselves in a situation where for whatever reason we want to change the accounting policy, then the change process must follow the guidance that we have in IAS 8 on changes in accounting policies, estimates, and correction of errors. Now, to highlight the change that has been made to the standards to IAS 40 with respect to transfers of properties, I'm going to put some scenarios in front of you that I'd like you to take a little bit of time to consider and see from where you're sitting, based on the information that you've got on the current wording in IAS 40, how would you deal with these scenarios? Or how would you classify these particular assets? Would they be investment property or would they be something else? Let's deal with that first, then we'll come back to the bit about the change in use as soon as we're done with that. So if I have land that is held for a currently undetermined future use, the answer that I should get for that, and I'm hoping that you've arrived at your answer already, is that is investment property. If I've gone and invested in property that I don't know what I'm going to use it for, in the back of my mind somewhere there must be a presumption that there will be capital appreciation from it. I may not necessarily earn any rental income because it hasn't, maybe the piece of land has not yet been developed yet as yet, but hopefully with time I will be able to get my return from that investment. And that's effectively the capital appreciation bit of the definition of investment property. A portion of a building that is held to earn rentals, and another portion that is held for administrative purposes. Again, when one considers the definition of investment property, property that is held to earn rental income or for capital appreciation or both, the one bit of what we're talking about here, the portion of the building that I'm using to earn rental income, must qualify as investment property. Whereas the other bit that I'm using for my own purposes, well, meets the definition of owner-occupied property, IAS 16. I should be classifying that as property, plant, and equipment. Now, in accounting for these two portions of this asset, IAS 40 then gives us some guidance, and it says, could you sell these two portions if it came to that? So you may find that in some jurisdictions you can sell a portion of a building, maybe under a sectional title type arrangement. If you could, well, can you determine the value of the portion that you're renting out, the value of the portion that you're using yourself, and then based on that you can attribute value and cost to the two parts. If not, well, then ask the question, the portion that I'm using myself, does it constitute a significant part of the entire building? And to the extent that it doesn't, well, then maybe classify the entire thing as investment property. And to the extent that maybe it does, you may want to consider classifying the entire building as property, plant and equipment rather than investment property. But make a call based on the usage of the building. A building held by the entity under a finance lease and leased out under an operating lease. This one we shouldn't get wrong because we dealt with it before, and when you looked at the definition of investment property, this was dealt with specifically under the definition. So therefore we can classify finance lease that where we've got a sublet arrangement, classify that as investment property, because our intention is to earn rental income from that subletting process that we're going through. So therefore we can, and that's a choice that you've got here. You can classify that property as investment property. A building that is vacant but is held to be leased out under an operating lease. My intention here is clear. I've got a building that I'm holding with the intention of leasing it, earning rental income from. When I invested in this building, that was my intention. It's still my intention. I just happen to have gone through a period, a month or 2 months or whatever the period may be, where I've not been able to get a tenant for it, but my intention is that I will generate rental income from it, or at the least. And in addition, I may also get capital appreciation. I may generate capital appreciation coming out of it. So that meets the definition of investment property as well. Now comes a tricky one. A townhouse complex occupied by the entity's employees. The employees pay a market-related rental. As much as I'm generating rental income from this property, it is also property that is used by my staff. So because it is used by my staff, it qualifies as owner-occupied property. So forget the rental income that is coming in, it's the use to which the property has been put that we need to consider. Now because it's used by your staff, the fact that they may be paying a market-related rental income, that's besides the point. It meets the definition of owner-occupied property and therefore must be classified as property, plant and equipment, must be depreciated and so forth. The whole bang tutti that you normally get with things that are dealt with under IAS 16. Provision of security and maintenance services to the lessees of a property that an entity holds. Well, these services that I'm providing are effectively generating rental income for me. Not rental income, generating income for me. So that's revenue. If that income that I'm generating constitutes a significant part of what we ultimately generating from rentals, constitutes a significant portion of the total income that we're generating in addition to the rentals, then we need to consider whether or not it's an owner-occupied property. A simple case in point is where you're running a hotel, for instance. So you've got short-term, effectively what are short-term leases of the rooms, but at the same time you're providing a whole bunch of other services, so that because of that it then works out to be a owner-occupied property, because the rental income that you're generating is incidental. Well, is maybe not incidental, is not the right word, but it happens to be a portion of the total revenue that you're generating from the use of this asset yourself. In a scenario as we've described now, where we're providing security and maintenance services, it is unlikely that the security and maintenance service income is going to far outweigh the rental income that is coming in. So from that perspective, chances are the property can still qualify as investment property. Property that is being developed for future use as investment property. As the wording implies here, I'm building this property with the intention of using it as investment property. So because of that, my classification will be investment property right from the onset. We used to have a situation many years ago where if property was being built, it was classified as property, plant and equipment, and then subsequently transferred to investment property upon completion. Now that was changed, and in changing it, the thinking now is, if my intention is to use that property for capital appreciation or to earn rental income, and I've known this right from the onset, then I need to classify it as investment property right from day one. Property that is leased to another entity under a finance lease. Folks, if I've got a finance lease, then all I should be showing in my books is the debtor. It's not investment property. All that is receivable by me is the amount that I've advanced the other party. I've effectively advanced them an amount of money and they're paying me back. So therefore I need to show the debtor in my books. The property itself is derecognized. It might act as security against the debt, but that's all. Property that is leased to another entity in the group. Again, another one that's a little bit tricky. From a separate financial statements point of view, we certainly have investment property because Company A is leasing property to Company B. Company A owns the property, is generating rental income from the property, capital appreciation, and so forth. So from in its separate books, that is certainly investment property. From the group that Company A and B belong to's point of view, this is owner-occupied property because the group is using this property. And with the group using this property, it must be classified as owner-occupied property. All of this is the thinking behind what is sitting in IAS 40 at the moment. Now let's have a look at the transfers. So where we have a transfer of an asset from investment property or to investment property, when do we change the accounting? The amendment that has been made to IAS 40 says that an entity shall transfer property to or from investment property when and only when there is a change in use of that property. It goes on further to elaborate. This happens when and only when an asset meets or ceases to meet the definition of an investment property and there is evidence of a change in use. I cannot stress enough those two bullets that we've just spoken through now. The asset must meet or cease to meet the definition of an investment property, and secondly, there must be evidence of change of use. Your intention to change use does not necessarily mean that you've actually done it. There must be something there that actually indicates, that demonstrates that there has been a change in the use of this particular property. Now, transfer is limited to situations in which the change in use has actually occurred. Hasn't occurred yet, we're still intending on doing it. Don't make the change yet until the change actually happens. I'm going to take you through a few scenarios here just to highlight what it is that we're talking about and how the change in use would then be dealt with. Company J owns an empty building that they were advertising to let to tenants. During the year, they commence with redevelopment of the property with a view to occupying it themselves. So we got a scenario here where we've had investment property. That's what it's been classified as. And we decide, well, for whatever reason, maybe we can't get tenants in, we're going to change the use, redevelop the property and use it ourselves. The point at which we take the decision to redevelop and we start with the work of redeveloping it. At that point, this asset changes its nature, it changes its classification from investment property to owner-occupied property. So for that whole period during which the redevelopment is occurring, even though we're not occupying it ourselves yet, but we've already taken the decision that we're going to fix it up such that it meets our specifications if we're going to use it ourselves, that from that point onwards, the property now meets the definition of property, plant and equipment, and we're applying IAS 16 to it. That's one scenario. Another scenario, Company B has property that they use for administration. They enter into an agreement to lease the property to company C. The inception date of the lease is at the beginning of the next financial reporting year. Here, this is the exact opposite of what we've just been through with the first scenario. In that we're currently classifying this as property, plant and equipment, and we're changing it to investment property. So if we've taken the decision and this is what we're going to do, the classification will only happen at the point at which the lease arrangements will start. So for the remainder of this financial reporting period, we still show property, plant and equipment. But from next year onwards, we then show that property as investment property. Now there's a little bit of a trick here too that we need to be aware of. Because I've been depreciating this property, maybe I'm carrying it at costless depreciation. At the point at which I reclassify it to investment property, I need to determine valuation of the property. What is its fair value at that point? Determine the fair value of the property, recognize a revaluation of the property at the point at which you make the adjustment. So I'm assuming here that the carrying value of the property under IAS 16 is less than what the property would be worth on a fair value basis. So revalue the property first, and then once it's revalued, you then transfer the property to investment property. This is now to avoid us recognizing a profit on changing classification of property, plant and equipment to investment property. So your policy might be to carry the property, plant and equipment at costless depreciation, but for the purposes of enabling you to transfer it to investment property, you have to revalue first and then transfer. Obviously that will need to be explained in the financial statements that this is what you've done, and this is the consequence of the accounting that you've applied. Another scenario, the financial manager has indicated that company M intends to sell one of their investment properties at the beginning of the following financial year. Does this change the classification of this investment property? Absolutely not. It's still investment property. But what we need to consider though is, does this property meet the definition of a non-current asset held for sale? Should we be applying the principles that IFRS 5 has got on this? Another scenario, Company X builds and sells office buildings. They are halfway through a new office building in London and have decided to lease it out instead of selling it. Construction will take another 6 months and they have already signed a lease for the new building. So here we find ourselves in a situation where we had inventory on our books, and we've now decided to take that inventory and use it ourselves. So if that's what we've done, again, there's a change in classification there, and in changing the classification, we've already started actively looking for tenants. We've signed a lease already signed a lease with a third party who's going to come in and lease this building. Again, that says to me classification must change immediately, because we're already actively looking and using this building based on what our intention is, or what the change in the decision making around it is. So based on that, classification must take effect immediately. The last scenario, Company H has a building that they rent out to Company G. Company H then purchases 60% of the shares in Company G. I gave you a scenario that's similar to this before, but not in quite the same words. Company H has now acquired Company G. We assume that at 60%, that's a controlling stake. So if they've now acquired a controlling stake in Company G, then these companies all make up the same group of companies now. and that the property that has been the subject of this rental agreement is now owner-occupied property. So it changes its classification from being investment property to being owner-occupied property, but only from a consolidation point of view. From company H's separate financial statements point of view, the property remains investment property. When does all of this take effect? When does this particular change that this scenario gives us take effect? At the point at which the acquisition happens. The point at which company H acquires the shares in company G, company H is now required to go and start preparing a consolidation. So from the date that they acquire control, from a group perspective, the property changes its classification from investment property to owner-occupied property. All these changes that both these changes that we've spoken about to IFRIC 22 and to IAS 40 become effective for years on or after 1 January 2018. That is what we have in IAS 40. Okay. Folks, that's it for our webinar for this particular webinar. Thank you very much.